Good evening, friends. I welcome you all to this very interesting fireside chat with Mr. Akhilesh Ranjan on digital economy taxation in the post-COVID-19 world. I would like to compliment the chairman of the International Tax Committee, Mr. Rajesh L. Shah, as well as immediate past president, Mr. Hinesh Doshi, who made this possible. Friends, it has been endeavor of the Chamber of Tax Consultants to organize as many webinars as possible during the lockdown period. In the month of April, for about more than 800 professionals. So that itself speaks of the importance of the topic. And more than that, the speaker himself, Mr. Akhilesh Ranjan, who is a very popular
Vipul bhai, your voice is breaking up.
knowledgeable
Vipul bhai, you're not clear.
Your voice is breaking up. Your bandwidth is really low.
So,
I think we have lost him.
thank you very much, sir, for accepting the invitation of the chamber. And I'm sure of the international.
I think we have lost him also.
Yes, somebody
Is
wants to
there-
take over.
I will take over. Thank you.
Yeah, okay.
Yes, please.
Good evening.
Anish, you are on mute. Huh.
So
He has
just
started.
switching on my camera.
Yeah.
Thank you everybody for attending, and sorry that people's bandwidth is a little low in the times of lockdown. Sometimes we have this. So from the chamber, I would like to welcome each and every one of you and convey my thanks and the chamber's thanks to Akhilesh ji for coming and addressing us today. I would also like to thank Rajesh El Shah, the chairman of the International Tax Committee, and Hinesh Doshi, immediate past president, for being able to make this fireside chat possible. Uh, you know, uh, the happenings of the recent times have led to a lot of uncertainty, and tax uncertainty is also an uncertainty amongst them, because in this post COVID-19 world, most transactions will now happen digitally. As we are aware that India has introduced an equalization levy on e-commerce transactions. India also has significant economic presence as a measure of business connection in Section 9 by virtue of the explanation. So, it will be an interesting debate to figure out what the future holds in store as far as tax is concerned also, because, as far as different countries are concerned, each of them will also try and, tax transactions that they believe should be taxed, and each of them will struggle for tax revenue. So it is going to be an interesting time for tax professionals going ahead. And we could have had no person better than Akhilesh ji to take us through all of that. So with that, let me again thank everybody on behalf of the chamber, and thank you for participating. Thank you, Akhilesh ji. May I turn the session over to Rajesh L. Shah, who will take us through what is in store for us, and also introduce Akhilesh sir for us. Thank you.
Well, thanks, Anish. Am I audible?
Yes, Rajesh.
Yes, Rajesh
Yeah.
bhai.
Okay. Welcome, sir, Mr. Akhilesh Ranjan. We are very indeed grateful to you for accepting our invitation to have a fireside chat with Mr. Anish Thakkar on digital economy taxation in the post-COVID world, where it will cover Equalization Levy, significant economic presence, OECD Pillar 1 and Pillar 2 approaches, economic aspects of digital tax, MLI, contemporary international tax issues. Before I go on to introduce Mr. Akhilesh Ranjan, the format that which we have planned out is that initially Mr. Akhilesh Ranjan will speak for 30 to 45 minutes. He will give his brief history and background, everything. And then Mr. Anish Thakkar will moderate and ask him questions, around 20 to 25 questions, which we have finalized. So he will have a discussion with Mr. Akhilesh Ranjan, and then we'll throw open for the chat, and you can also send your queries on the chat box, which will be taken after all the questions are over. So now I will just introduce you briefly. It's a very big long biodata which we have of Mr. Akhilesh Ranjan. So I will just introduce him briefly. Mr. Akhilesh Ranjan was a member of the CBDT in charge of the legislation, tax policy and international taxation till the recent retirement in December 2019. Prior to that, he was principal CIT heading the international tax and transfer pricing. He has been in the Indian Revenue Services since 1982 and has a rich experience of direct tax administration in India, having worked in various capacity in key policy making and operational roles. He was a part of Tax Policy and Legislation Division of CBDT, Ministry of Finance from 2000 to 2004 as a director and as joint secretary. He was appointed as Indian Competent Authority under India Tax Treaties and joint secretary in July 2013, and he was participating in the G20 OECD BEPS project and is credited to having secured greater understanding and global appreciation of India's policy and implementation in the field of international taxation and transfer. He has successfully resolved a large number of disputes with several countries under the mutual agreement procedure provided by DTA, and he was instrumental in launching APA in 2013. He was nominated by the Government of India to function as the chair of the Working Group on Tax Policies and International Tax Cooperation established by G24 Intergovernmental Group of Developing Nations. He was also appointed in November 2018 as the convener and head of the task force set up by the government to redraft the income tax law in India. Considering his various accomplishments and contribution to the formulation of the direct tax policy in India and globally, Mr. Ranjan has been included in the Global Tax 20 named by International Tax Review for 2013, 15 and 18, which is an annual listing of tax leaders who have made a significant impact on tax policy at a global level. With these few words, I welcome you, sir, and request you to take on the proceedings.
Right. Thank you, Rajesh bhai, and thank you to the Chamber of Tax Consultants for hosting this webinar. It's always a pleasure talking to members of the chamber, and I think there's an opportunity even in these days of lockdown. I think one should not miss out on these opportunities. So thank you again for inviting me over. This topic of taxation in a digitalized economy is something on which a lot has been written, a lot has been examined, a number of views have been expressed. I have come across a number of articles and write-ups, some very erudite and very learned articles on different aspects of what's happening. So I don't intend to really go into the deep technical aspects or the nitty-gritties of of digital taxation or what is being contemplated in the world. But I think it's extremely important to be able to understand what's really happening on a very broad picture level. How are the discussions progressing in international taxation? Where did we start from? Where are we now? What is it that we can look forward to in the years to come or the months to come? And what can India's response be? Not just a response of India as the government, but also the response of the tax administration, the response of tax consultants and professionals. So let me I would also like to just mention that when you are talking about taxation in a digitalized economy, we are not just talking about uh, taxing a particular kind of income, and we're not talking about taxing income from a particular kind of business model. The discussion is much broader. The implication is much broader. What we're doing is trying to come to terms with changing business models that have changed to such an extent that several of our traditional concepts seem to have lost their meaning. What is meant by physical presence? Those concepts have become obsolete. What is meant by uh, things like the separate entity principle? That is something which a lot of people had a lot of views upon, but that's something which is coming up for being questioned in more and more. What is meant by the arm's length standard? These are all concepts and principles which we have held as sacrosanct when we talk about international tax. But it is these concepts and principles which are being attacked and sort of destroyed by these new business models, which are just do not depend on any sort of fixed places of business, do not depend upon uh, um, of conceptualizing separate entities. They are something that we might need administrations and governments the world over to review the tax laws, to modify those tax laws, and to bring them in line, or in fact, even to abandon some of the concepts. And that's the importance of this discussion on taxation in a digitalized economy. And let me take you then back to the beginning of the BEPS project when this whole discussion really started. 2013, when the OECD drew up a 15-point action plan. It had some very good action points in it, just such as the anti-treaty abuse, etc. Uh, it also had as action point one uh, challenges thrown up by the digital economy. And that was supposed to be an extremely important part of the BEPS project because it was known even at that time that the digital economy had thrown up challenges, was threatening to disrupt a number of principles that we had always relied upon, and therefore it was something that needed to be explored. But when the discussions went on during the BEPS project, India appeared to be the only voice which kept maintaining that a separate scheme of taxation, a new way of taxation seemed to be required. We couldn't get support from other countries, or they were not willing to support us on that point, all except maybe France and Italy to some extent. But the US, of course, maintaining that nothing special was required, that the traditional concepts were enough and sufficient to handle any of these problems. But we managed somehow, when the final report came out in October 2015, we managed to put in or have some chapters put into that report, which did talk about the challenges posed by the digital economy. The problems or the challenges which were based on the fact that business could now be done without a physical presence, challenges posed by so many different business models where the streams of income themselves were not being understood. And the chapter in that report also finally gave a couple of options, in fact, three options for governments to consider, saying that governments could implement any of these as long as it did not interfere with the tax treaties. Well, after the BEPS was over, I think nobody really expected anyone to do anything or to take any measure because things were so fluid. But then India did. We were always very clear in our minds that we need to act on these challenges. We need to ensure that we come to a more just and fair taxation system when we talk of the digitalized economy. And so we enacted the Equalization Levy, which was one of the three options mentioned in the BEPS report. We kept the levy as separate from the Income Tax Act. We said it is not an income tax, but it is still a tax uh, which has something of the same nature as income tax. We said that we will tax income on a gross basis, but restricted this levy to certain types of services, in fact, only advertising services, and restricted them to business transactions. So it was a small beginning, but then a clear statement of intent on the part of the government of India, on the one hand, and secondly, uh, a system of taxation which could be a very efficient system of taxation after due calibration. So, when the second phase was launched, we found that very soon many other countries and jurisdictions started following India. The European Union started talking about a digital services tax. Countries like France, UK, Spain, and Italy, New Zealand, Turkey, several countries started examining the possibility of introducing such a legislation. It is clear that a number of countries were convinced that unilateral measures could be taken to tax this income. Now, obviously, all these types of taxes would be outside the tax treaties. Uh, all of them would most certainly give rise to double taxation, and therefore, this created an alarming situation, in fact, in the world. And that's when the G20 decided that a consensus solution on a better way of taxing income from a digitalized economy should be found. Discussions went on then in the post-BEPS scenario, and efforts were made to find a consensus on what to happen. But then there was an interim report uh, of the inclusive framework in March, I think 2018, which again brought out these stark differences of opinion amongst countries. There was no agreement on how to tax, or some countries, in fact, again maintaining that there was no need to have any new rules. Some countries maintaining that a new nexus rule was required. Some maintaining that traditional transfer pricing with a bit of tweaking could handle the situation. But in the light of the fact that there was no agreement, no discussion could progress to any concrete level. And that's when the US came up with an ingenious idea. The US, of course, realized that if it doesn't do anything now, it is the US companies which are going to suffer. It is the US companies largely who will be subject to double taxation. And in a way, US hand was forced to take some action. But they did it in an extremely intelligent fashion. They said, all right, we now think that we can take this discussion to a different level. We will talk about allocation of taxing rights. We will come up with some new rules which can allow market jurisdictions to get some taxing rights on incomes of multinationals, uh, even if there is no physical presence of the multinational enterprises in those jurisdictions. And they said that since the market does contribute, um, and this will take care of the contentions being raised by countries like India, that value is created by the market forces, and that if you can tweak the arm's length principle to some extent, if we can uh, find a way of allocating profits in a new way, then we can certainly evolve a new nexus rule which can allow taxation of some part of the profits of multinationals in market jurisdictions. And it seemed a very good idea because suddenly, for the first time ever, the US was talking about a reallocation of taxing rights. And that's something developing countries like India had been asking for a very, very long time. Because the current system, which is embedded in the tax treaties, in the model conventions, is heavily biased towards the supply side, towards the producers, and not towards the market. So therefore, when the talk came of allocation of or reallocation of taxing rights, countries like India were happy. They said, yes, we should get into this discussion. We will participate and try and find a consensus. But very soon we realized that when the US talked about market jurisdictions, it was talking about marketing intangibles developed by the producer, the supplier. Whereas countries like India were talking about the marketing intangibles developed by the market itself in India. So there was a clear difference between what was conceptually thought about by in the US approach and in the Indian approach. The problem of the US essentially was that the US also has a deep and a vast market. And it has the problem of low risk distributors acting in the US who were offering nominal amounts of income for taxation. Normal transfer pricing was not able to get more income out of these enterprises in the US. And therefore, the proposal of the US, which was talking about marketing intangibles and talking about reallocation of taxing rights to market jurisdictions, was actually a proposal which would help the US itself to get more tax out of the low risk distributors and other entities. And hence, the US said, okay, we will tweak the arm's length principle because normal arm's length principle does not yield any income from low risk distributors. In any case, that even though that logic or that understanding was there was no reason why not to participate in the discussions and go ahead and try and find consensus solutions. And that's why we went on. There was a proposal from the UK. Now, this was a proposal which was very specific, which was pertaining essentially to highly digitalized enterprises or services. And it was talking about the user base as the primary base for allocation of profits. Again, the UK proposal was not primarily for evolving a new nexus, but for evolving a new way of allocating profits so that some profits would be allocated to the jurisdiction of the users and not just to the jurisdiction where business was being done or where the physical presence was established. So the UK proposal also came on for discussion. It was a restricted proposal, narrow in scope, but yes, it did recognize that highly digitalized services needed to be taxed in a different fashion. So all these discussions came up in and around the end of 2018, or beginning of 2018, India was confronted with the choice of whether to go ahead with these discussions or not, and we decided we will participate, even though neither of these positions were according to what India believed. And since they were not in line with what India believed, India formulated its own proposal. We had by then the significant economic presence on the statute. We built a proposal on the significant economic presence with some threshold, with some criteria, and along with a method of allocating profits on a formulaic basis, calling it a fractional apportionment system of allocating income. And then just so that we could get the views of other developing countries, we brought this model, the Indian model, let us say, to the notice of other developing countries through the G24 forum. I happen to be the head of the working group on tax of the G24. It actually comprises 28 developing countries, but I don't know why it's still called G24. But some important countries like Colombia, Nigeria, South Africa, Brazil, Argentina, I mean, these are all there. So when I raised this issue in that forum, there was widespread support for the significant economic presence proposal and also for the method of allocation of profits on a formulaic basis. Developing countries were fed up of complexities in transfer pricing. They wanted a simple system simple to administer, simple to understand, but at the same time, something which gives adequate revenue. And so, because of the support garnered from the G24 developing countries, a proposal was officially submitted by the G24 for discussion in the inclusive framework. So now we had three proposals: the US proposal on marketing intangibles, the UK proposal on user contribution, and the G24 proposal on the SEP and fractional apportionment. The G24 proposal actually being more or less the India proposal. And that's where we started discussing in all seriousness. The OECD then decided to try and formulate a unified approach, trying to bring together elements of all these three proposals and trying to bring a single common approach or a model which could be acceptable to all. And but then this unified approach was essentially based on the marketing intangibles principle the US was talking about. And again, as I said, it was all about intangibles created by the supplier, by the producer in a market economy, in the market jurisdiction, rather than intangibles created by the market itself. So obviously, then there came various ways of allocating income: amount A, amount B, and amount C. You all have read about it. The fundamental idea being that, look, the normal existing way of allotting or allocating profits on transfer pricing principles will continue. So countries which have a physical presence, a marketing arm, or a subsidiary will continue to have income allocated to them through normal arm's length principles. There may be, in some cases, excess profits of the enterprise as a whole. And if that is the case, then that excess or residual profit will be allocated amongst all the countries again, based on the market, and the parameter of the market being the quantum of revenue. So allocate that residual profit according to the revenue. And then, of course, not the entire such profits, but only a portion of that profit, because some part of the profit would always be ascribed to the intangibles or to the IPRs held by the parent company. So this was the sort of a unified approach that was constructed by in the discussion papers. It still stuck to the arm's length principle to a large extent. It is only when allocating that excess or residual profit that the proposal talked about a formula approach, a formula which is based mainly on sales. And there was no separate or clear talk of nexus. The nexus was to be built in only for the purpose of being able to tax this income. And so this, when India responded to this, we pointed out all these things, that our main interest was on nexus, which was a fundamental requirement. One had to define an alternate nexus first and then talk about allocating income to that nexus. And we wanted to find better ways of allocating income. We said, if we are departing from arm's length principles, then let's depart to the fullest extent. Also, we said that once we have a nexus, that nexus, which is based on economic presence, substitutes for a physical presence. Then how can you bifurcate profits into routine profits and non-routine profits? Then all profits must be allocated according to that nexus. That nexus is based on, again, on the level of activity and the level of interaction, and therefore could be based on parameters like sales revenue, on the number of employees, or the asset base. But then the discussions, of course, kept on without reaching any finality. And we decided to then ask questions on what really is the scope of the levy, what is proposed in this unified approach, and what is to be covered. Because it appeared that the US was primarily interested only in consumer-facing businesses, which meant B2C transactions, not leaving out everything else. But when this debate on the scope started, then a large amount of resistance came up from different countries, because the scope really was not adequate. It was just limited to some consumer-facing businesses where the ultimate consumer who's going to use these goods is situated, and only those sort of economies or those transactions would be considered. It would leave out massive transactions which are B2B, but also in the form of digital transactions. It would leave out many other things which for us were extremely important. But because of the huge amount of protest and I won't call it protest, but disagreement all across countries, um, there was a realization that the scope had to be enlarged. We had to cover at least all the digital services, and then if you want to include consumer-facing businesses also in the traditional sense. So, but when this realization came in, we got another whammy from the US. Sometime I think in December 2018, the 19, I think, that when the US said that gave a letter to the OECD inclusive framework and said that, look, we are not very comfortable with moving away from the arm's length principle, and we are not comfortable with defining a new nexus, which meant that the whole basis of the new proposal had collapsed. If you are not willing to define a new nexus, and if you're not willing to depart from the arm's length standard, then the entire manner of allocating profits falls through. How do you decide that? There is no conceptual basis then remaining. But then the US said, but yes, is okay, we will accept these discussions as a sort of a safe harbor. We will continue participating, we will come to some agreed conclusions, and but then those will be as a sort of a safe harbor for our companies, up to them whether to opt for it or not, or else face the consequences in different jurisdictions. So on that basis, once again, the discussions continued, and that's where we are. In fact, at present, the G20 has reiterated that consensus must be found. The timeline, of course, was the end of this year, but then with the corona disruption, I think the timeline is bound to get a bit extended. But then the G20 is certainly very clear. Even just last month, the finance ministers have reiterated that we have to find a consensus solution. So the consensus, of course, we will work out. Something will happen. Something will come out of it. Maybe not what we would have desired, maybe not what we would have expected, but some tangible gains are expected. Firstly, we believe that there is general agreement now on the need to define an alternate taxing nexus. So whether you call it a significant economic presence or a significant digital presence or whatever, a new alternate nexus will be defined, and it will find place in the tax treaties. Secondly, there is a departure from the arm's length standard to some extent. There is an acceptance that in highly digitalized transactions, it is impossible after a certain stage to allocate income based purely on transfer pricing. So once again, so these two net results are something which for India are important, even though we may not achieve the level of taxation of in a digitalized economy that we would have wanted, at least these two concepts will be understood and accepted the world over. And that is what we hope at the moment. Of course, once we define a new alternate nexus, there are other things which will follow. New discussions on taxation of new transactions in a different manner. But this is where we are at the moment. The reports have not been finalized. The consensus has not yet been reached. Discussions are on. Meanwhile, of course, we had the equalization levy. We had always said that uh, till such time as a consensus is reached internationally, we will tax at least some part of this income through the equalization levy. And in this current, the last budget, the scope of this equalization levy has been considerably expanded. I won't use the word expanded. I think a second component of the levy has been introduced. If you notice the new law, it's the existing equalization levy on advertising services continues as it was. A new levy has also now come in, which is extremely broad in scope. And I know that there are many concerns on that, on the breadth or the width of that levy, and how it will play out really in future. But that's something that we will discuss maybe a bit later. Right now, yes, that levy has been introduced. It is part of the law. It is bringing in a whole range of incomes, not just advertising incomes. It will cover things like streaming services income. It will cover the new gig and sharing economy, the Ubers and the um, uh, IBBOs. It will cover a whole range of digital transactions. How it will play out, how do we really implement it, how do we actually compute those amounts is something that has to be seen in the future, something that has to be devised. But yes, the levy is here, and as yet there has not been, according to me, I have not read, there are some representations and protests from chambers of commerce, from organizations which represent industry interests of the US and of Europe, uh, but not too much of a protest from governments really. And perhaps there may be a high degree of acceptance. If you see the atmosphere or the prevailing environment, no country really is very confident at the moment of finding a consensus solution. Everybody is hoping for the best. Everybody is hoping that we will find some way by December or by next April. But there is no real confidence that yes, we will. And if that is the case, then countries will have to think. Will have to think how can they get their revenue from these enterprises. They can't just sit back and wait for eternity. And that's so it's possible, ladies and gentlemen, it's possible that the model or the initiative that has once again been taken by India is taken forward by other countries too, if discussions don't progress. So that's the stage where we are, and in as far as the digital economy is concerned, there is no real final set of rules, but then extremely hopeful that something will come out of it. At least some conceptual improvements will come out of it, and maybe some improvements on the levy, on the equalization levy. That's one part of what's happening in the world. The other part is on a very strong drive against tax avoidance, and that's the pillar two that is being talked about and also under discussion. The pillar two, which seeks to ensure that uh, jurisdictions of parent companies can ensure proper taxation of the multinational enterprise, can get the right amount of taxes, even if the subsidiary jurisdiction does not exercise its taxing rights to the full. You will recall in the BEPS project, although there was some talk of harmful tax competition in Action 5, there was no real effort made to try and evolve minimum levels of taxation, because that was considered to be something, a sovereign function, tax being a sovereign function of every country, BEPS being only to find loopholes and plug them, and being an anti-tax avoidance, anti-base erosion measure. So no recommendation was made in the BEPS project for bringing out any type of sort of uniformity in the rates of taxation. So tax havens continued, different levels of taxation continued in different jurisdictions. In spite of the recommendations of the BEPS project, in spite of the large-scale implementation, the possibilities of profit shifting continued, the possibility of base erosion continued. And that's why when the inclusive framework started discussing the digital economy, they also started thinking of new rules which can ensure a minimum level of taxation of multinational enterprises all over the world. So these proposals, which are based on approaches like income inclusion, where the parent jurisdiction can tax the income of the subsidiary, overseas subsidiary also to a certain level of minimum taxation. It can cover things like denial of deduction, whereas for example, if the Indian company, the subsidiary pays royalty to a concern which is not being taxed in that jurisdiction, then perhaps you could disallow that part of the deduction of the payment. It could extend to non-granting of treaty benefits, the subject to tax principle, that if the payment of interest from India is not subject to tax in the other jurisdiction to the proper level, then India would have the right to tax or to deny the treaty benefit and tax it as per the domestic law. So these are the different ways in which a minimum and an average level of taxation is sought to be introduced under the Pillar 2 approach. Simultaneously, the MLI, which was the product of the BEPS project, the MLI came to be drafted. It came to be an instrument which was found to be workable and efficient. A large number of countries have signed and ratified the MLI, in India included. And therefore, the basic provisions of the MLI, mainly relating to the anti-treaty abuse, are now going to become part of tax treaties. So the principal purpose test is, I think, the second major development the world over. Although the BEPS project had given options of a simplified or a detailed LOB instead of a PPT, but then I think most countries of the world have opted for the principal purpose test, which is a sort of a treaty GAR. And if that's the case, then a new way of taxation might just come about in the world because of application of the PPT rule, which can start happening very soon in the year 2021 itself. And along with the PPT, in the treaties, we have the domestic GAR in India as well as in several other countries now. GAR has come to be accepted as something which is essential, something necessary. Most important economies who are really serious about their tax systems now have a GAR in place, a general anti-avoidance rule. So there are questions, of course, issues of interaction between the domestic GAR and the treaty principal purpose test, which has precedence, which can they both exist together. There are some FAQs issued by the CBDT. Some issues are clarified, a number of issues need to be clarified. The actual implementation of the GAR provisions in the light of the changes in the treaties now has to be seen. the administrative mechanism which has been set in place for the GAR is not yet fully functional. Those are issues that we have to really, it's not just the tax administration or the government which has to act fast on that. It's also the taxpayers and the tax consultants who have to gear up to face those challenges. We have to, in the administration, in the government, we have to come out with those rules. We have already made certain rules. We have to come out with the appointment of the approving panel, for example. We have to consult stakeholders. We have already had one round and issued a set of FAQs. I think it is time now, in the light of developments like the PPT rule, in the light of further thinking of the subject, for the government to issue a fresh set of FAQs. That is solely needed because GAR is a territory which is not really understood, and an understanding of those concepts must depend upon a large number of examples and real life situations which have to be examined. So the pillar 2 discussions on anti-avoidance, the PPT and the GAR are the second major development that we have to take note of and work towards. And in all these discussions will happen in the framework of multilateralism, and that's the third major development happening in the world of tax. Tax is now no longer bilateral. Policy changes are being driven by multilateral consensus. Even the computation of profits taxable in a particular jurisdiction will depend upon concepts like consolidated profits, average rate of returns, average rates of tax. These are all concepts which were not being thought of earlier. Now, the pillar 2 proposals, for example, if you try and find out what should be the average rate of tax and what is the average rate of tax for an enterprise, then you have to first determine what the consolidated profit of the enterprise is globally, and then try and determine the average. So from the profit of an enterprise from a particular transaction, we have moved and gravitated towards profit of the enterprise as a whole. And once we do that, then we impose average levels of taxation. We could also then allocate profits on a formulaic basis without resorting to the arm's length principle. So this is an important development of how things are happening, how we are moving from single entity to consolidated entities. In this process, the principle of the separate entity approach is also gets modified. The relevance of the separate entity becomes lost to a large extent. And if that happens, then consequentially the arm's length principle also loses much of its strength, because arm's length applies based on the principle of the separate entities. You assume that the associated entities are actually separate entities. But if you don't assume that, if you're taking all of them together and taking the consolidated profit as a measure, then where is the need for arm's length transactions of traditional transfer pricing? Then we could think of profit allocation methods. We could think of broad spectrum of profit splits, which could be based on parameters which have nothing to do with traditional transfer pricing. So these are areas that we are the future. That's what I think. The understanding of the digitalized businesses, the reallocation of taxing rights, the construction of a new taxing nexus, devising of new methods of profit allocation, getting over the separate entity approach and the arm's length principle. These are the new movements that are happening in the world of tax, and this is where we are and what we need to discuss in the times to come. What should be done? What is the response that is expected? I think the basic response is that of openness to change. Tax administrations, tax governments must be open to change, must be open to think of new policies. taxpayers must be open to change. They will have to, of course, change their business models, some of their systems, their ways of planning out transactions. Tax consultants need to be open to change, and all these uh, might then ultimately result in a world which is where the amount of profits that are taxed in India are decided not by the government of India, but by some entity which is analyzing the consolidated profit of a multinational enterprise and allocating part of it to the Indian jurisdiction. So interesting times, and that's where we are at the moment. Uh, as far as tax consultants and professionals go, I think we have to try and come to terms with these processes of change. And I think uh, the bottom line, of course, will be that we have to think of the anti-avoidance measures. We have to give primacy to substance over form. So as long as our planning structures give precedence to substance, I think most of the new developments will be taken care of uh, in all tax arrangements. That's the opening that I wanted to say. I think I've taken a lot of time, and thank you so much. Would be very, very happy to respond to some questions, queries. Thank you.
Thank you very much, sir. Very insightful and very interesting address, and gives us a lot of food for thought, actually. We're probably going to put you a little bit on the spot with regard to some very specific tax development. And the first tax development that we'd like to talk to you about is the equalization levy, really. And you know, uh, obviously, yes, in 2016 when the levy came in, it was a very restricted levy. It was probably very simple to administer. But when it comes to what has happened or what has got enacted in the Finance Act 2020, I think everybody's left a little surprised, stunned, worried in terms of what is this thing and how is it going to really be administered. So in that, the first question that we'd like to raise to you, sir, is really, are you happy with the way that this has been levied? It's sudden, it's a little abrupt, and it is very, very wide. So your initial thoughts on, could it really have been done better? What is it that was the thought process behind all of this?
Oh well, yes. Any such proposal which is trying to tap a sector of or types of business models that are not yet fully comprehended should be given more time to mature. But then I'm aware of the pressures that the TPL division and the CBDT works under many times, and the budgetary process that we have, which doesn't allow full consultation, and therefore, yes, it does appear that this levy has come in with a bit of inadequate consultation. I think there needed to be some more thinking about it, particularly because the scope of the levy is huge. It's very, very broad. And when you have such a wide and broad scope of a levy, which is tackling business models which are not very well understood, then then I think it would always have been better to define that scope in a much better way. So, and that definition of the scope takes time. It takes discussion and consultation. Um, well, but then at the same time, it is the law as has been drafted uh, does bring out the intention of the government that they want to cover every sort of uh, facility, income stream out there. And yes, I think it would have been much better if there had been more rounds of discussion before the rules were finalized or the law was finalized. But then I think I'm sure the CBDT would enter into that process of consultation now and try and refine and remove the rough edges.
Yes, sir, one does hope so, because there are a lot of aspects of the levy which need to be explained to the taxpayers in terms of how to enforce them, so on and so forth. One thing, sir, you said that the equalization levy was really looked at as an interim or a short-term measure. Now, obviously, on advertising transactions, we've had this from 2016. And now with this expanded scope, again, do you see this as more of a interim measure, or do you see this more as something that is there to stay for the medium to long term?
Well, that's a very difficult question to answer at the moment because uh, even just 6 months back, I think I would have said that no, equalization levy is an interim measure. It will certainly be removed as soon as we can find a consensus solution. But what is now very intriguing is, as I mentioned, what sort of consensus are we going to reach is not clear. And will that really be a consensus if the US says that no, for them it is merely a safe harbor for their enterprises, not a policy, something that they are in agreement with? Uh, and then if that be the case, if there is actually no real consensus, uh, then I don't know whether we will completely abandon, or countries around the world will completely abandon um, some way of taxing these transactions on a gross basis. So uh, normally, I think, and officially, these measures should go away. These are all interim measures. They should go away once a consensus solution is found. But then, right now, it does depend really on what sort of consensus solution is found.
Absolutely, sir. We live in uncertain times, and therefore, if we look at something like this, where this will probably go on for some years, then really the next question will be that we know that you refer to the fact that this was really not an income tax in that, right? And therefore, this was meant to be separate as far as tax is concerned. The only question, sir, that remains therefore is that how does one deal with tax credit in terms of the treaty? So if today India has levied this, but say other countries were to levy this for Indian taxpayers, then how would India probably look at this? Because then they may, or this may really amount to double taxation in that sense. And related question really on that is, does this really tantamount, or does this, or will this be looked at as a unilateral treaty override on part of country?
Uh, Answering the second question first, no, I don't think it's a unilateral treaty override. Um, it doesn't say anywhere that, irrespective of what the treaty says, it's a levy which is apart or separate from the domestic law entirely, income tax law, and hence it's removed from the realm of tax treaties. But the first part of the question, yes, absolutely, there will be double taxation. These sort of unilateral measures are certainly going to lead to double taxation. They must already be leading to double taxation, and the ones that we already levied for a year or for many years. But then, if countries around the world are in agreement, if bilaterally with our treaty partners we come to an agreement of the scope of this sort of a levy, and if both countries are in agreement that this can be levied on their enterprises, then I think a tax treaty, people or countries can agree to anything, as long as they're agreeing on a tax which is in the nature of an income tax. If you see the treaties, they normally relate to, when it say talk about taxes, they talk about income taxes, corporation taxes, and taxes of similar nature. And I think it can certainly be brought into that category of taxes of similar nature, where bilateral understandings could be there.
Right, sir. And I think that's interesting because if we look at how the tax is levied, really, and that also really in a way brings me to the next question in terms of what is the scope of the current equalization levy that India has now enacted. Does it really tax, or does it really contemplate taxing the entire transaction value, or does it really contemplate the income of, or the charges that the e-commerce operator or the platform owner or the platform operator earns? Because on a transaction value, the 2% may be a very difficult one to absorb for taxpayers.
True, I think it conceptually the levy is supposed to get an equivalent amount of tax as should have come from normal income taxation. And that's the genesis of the word equalization levy. We are trying to equalize the two. So there must be a relationship with income conceptually, and then and therefore I would agree with you that when an e-commerce operator facilitates transaction, then it is only his facilitation fees which should be brought, should be subject to the levy, and not the entire amount of payment that he gets. So it, yes, it should amount to the margin or the income or the actual income component which the e-commerce operator is deriving from the transaction, and it should normally be on that component. But the scope of the levy as drafted is huge, and it doesn't make these sort of things very clear. So that's what I meant when I said that when you are contemplating uh, introducing a levy which is so broad and so wide in its scope, then one has to be very careful in circumscribing the manner of implementation and how we can actually and what we really want to tax. Because as things go right now, I mean, we can tax, we can bring almost anything. Uh, Even somebody was talking about a non-resident bank providing services through the internet. Perhaps that bank could also become an e-commerce operator to some extent under the rules. So I think we have to be more clear on the scope, what we intend to be the scope of that levy. And so I think in the future, in the months to come, these issues will be taken up and sorted out.
Yes, sir. And I think, it's important again for us to isolate what the levy really contemplates. Because, if you see Google, for example, it will provide you a lot of data that you ask for without actually charging for it. And its revenue model is not built on selling some of the data to us. It is built on, certain other things like advertisements or all of that, subscriptions, etc. So from that perspective, again, clarity will have to emerge, I would believe, that what is it that the levy clearly contemplates, and if therefore there is really no charge for a particular service or a transaction, then really, would a value be ascribed to that service in the overall bucket of services? How would it work in your view?
Uh, well, I think this will have to wait for some discussions and some clarity on how really, because it does seem to cover a whole lot of things in its ambit. So I think some places, some exclusions have to be made, some terms have to be more defined in a better fashion. And I think perhaps I don't think I can really give a competent answer at present to that question that you have raised. It's only something that I hope that will engage the intention of policymakers for some time.
Sure, sir. Thank you for that. So the other thing that you mentioned, that there was some discussion that somebody was having with you, that it could potentially apply to even a bank rendering services through an electronic banking kind of platform.
Yes.
So is this really intended at those sort of services, or is the levy intended only to the highly digitalized services that you spoke about? Like the Ubers, the Go Ibibos, the Googles, etc. Here, because
Mm.
banking, even in the traditional days, used to go on, and the same service used to be provided in a manner which was not electronic. So really, is that, if we take the sky sale principle that the Madras High Court had, for example, it's a service, it's a standard service, you are using an electronic medium to render those services, but really, are those services also being contemplated?
Well, to my mind, they should not be. I mean, very frankly, um, I don't know what really is has been thought about while drafting the law, but to my mind, it should not. That is not the aim of the government also, and that should not be the intention. That's what I meant when I said that in all these sort of levies, I think we have to be very careful in defining a scope. You recall that even in the Pillar 1 discussions, the moment countries like India and all started pointing out the problems in the scope of the proposal, or the scope of a consumer-facing business, the whole proposal started undergoing a lot of change. And what we have now under discussion is something very different from what was there 6 months ago on the table. So defining the scope is extremely important, because there can be so many things which are not thought of, which are not contemplated, which might create problems, not just in administration, but also in understanding. This example of a bank, if the bank is charging commission on a demand draft, if it is doing something on the same thing online and some same thing on a physical basis, then how does it account for these two types of transactions? And where was the problem? I mean, that those incomes were always being shown. So the intention clearly cannot be to cover these sort of routine services which were always being provided, where the technology was being used only as a facilitator. Now, whether to we restrict this levy to e-commerce platforms or marketplaces, I think even that, but that also be not the right approach, because one there can be ways of rendering these services without using formal marketplaces. So the answer lies somewhere in between, somewhere, some a more clear definition of what we mean by terms like facility, or a digital facility, or an online service, and these are terms which need to be defined and clarified in a manner that can then make sense as to what really is the scope of the levy.
Absolutely, sir. And I think, you raised a very valid point that, the scope has to be completely clear. And today, as it is, at least we believe that the Finance Act does not really clarify. So hopefully engagement with the government will bring in more clarity. And let's wait for the lockdown to lift, and then maybe, more detailed engagement can happen. So the other question really is, in that sense now, economic burden ultimately will always, of any tax, lie on the consumer. So on this equalization levy also, would you believe that ultimately it is really the Indian consumer who will spend, and therefore really India's, economic base will probably reduce? Because ultimately, a service provider is not going to, unless he gets a credit like a GST, for example, he would always, load the tax onto the consumer, wouldn't he?
Well, yes, I mean, this problem was more acute in, or is more acute in the existing equalization levy of 2016, where the person making the payment is supposed to deduct that amount. So it is extremely easy for the non-resident to say that, look, I'm not bothered about the tax, you do whatever you want. And in the way of all tax-paid contracts, you ensure that the right amount of tax goes to the government. And that is one of the problems, one of the failings of the existing or old equalization levy. This equalization levy is now something which is to be borne, amount has to be computed by the non-resident enterprise, and the tax has to be paid by the non-resident enterprise. So it's no longer a question of the payer deducting, or the amount of tax could be built into the pricing. Of course, in a way, indirectly, of course, the enterprise could raise its charges to such an extent that, uh, in a way, the burden does fall on the consumer. But then that's the situation in any type of transactions. So I don't think that the new form of equalization levy, which is now being introduced, will suffer really from that problem to that extent. I think it's designed to be a tax computed and paid by the non-resident uh, subsequently, or every quarter after this business goes on.
Sure, sir. And let's hope that, we as a country have the wherewithal to, tap all of those transactions and make the non-residents comply. Because I would think that that's one more area really of concern that one has, right? In terms of the fact that, do we really have the machinery or the manpower, even, to be very honest, in the department to be able to track all of this? But
Yeah,
anyway, we'll
yeah,
leave that probably as a discussion for some other day, sir.
that's right. Yes, yes.
I think let's move on to, other more interesting issues. You would have read, sir, one article on 28th of April, where the media reported that the US may retaliate in terms of this being on India levying what they call Google tax. And we've also seen some debate on US versus France also on this. And therefore, would we think that this again will in a way lead to some sort of face-off between two jurisdictions, and conceptually again derail some of this good work that the OECD and the G20 countries have been doing?
Well, I mean, and that risk is certainly there, particularly because the US at present is undergoing pretty torrid times, not just because of the pandemic, but also because of approaching elections. And this is a time when governments are known to take some very strange decisions. And with Mr. Trump being there, so one really doesn't know what's going to happen. But I think, yes, the US did talk to France earlier, did persuade France to give a sort of an undertaking that they will refund the amount of tax collected as soon as the consensus solution is found. Uh, but right now, the situation has changed a bit. As I mentioned, the US is not really agreeing to this consensus solution. It is only saying that, yes, we will go along with it and we will offer this solution as a safe harbor to our enterprises. It is not something that the government or the treasury is planning to. According, that's my understanding. I don't know how discussions progress, but I have not seen any indication of, since that letter given by the US to the OECD, and that there is no indication that the US is going to sign and approve and wholeheartedly accept the new consensus. So if that is the case, and if it is going to be purely voluntary for US enterprises to fall within or opt for this scheme of taxation or not, then it becomes extremely difficult for the government of India to take a policy decision on the levy, and therefore, so I don't think really that the US can have much strength of conviction, even if it tries now to tell India to back off and not implement this sort of a levy, because they themselves are not on very firm ground.
Yes, I think let's hope so. Let's move away from equalization levy and probably just come to pillar one and pillar two. Now, I know you briefly touched upon pillar two, but just for the benefit of all the viewers on this webinar, if we could be a little more specific and explain how pillar two will apply to India inbound and outbound investments, that would be useful.
Okay, so as I mentioned, the BEPS project did not solve one very, very pressing problem, and that problem was the problem of low tax jurisdictions, what we term as tax havens or whatever, low tax or no tax jurisdictions, and because that was considered to be something within the realm of tax sovereignty. But then it was realized that as long as we let this thing remain, this freedom amongst countries to decide on their tax rates to remain, all other measures of anti-base erosion or anti-profit shifting might just fail. They might just not be effective enough, because countries will still opt or make their arrangements or their transactions in such a way that they are able to escape the taxes. So it was a realization that the BEPS recommendations had failed in one respect, that this pillar two discussions came up. Now, what does the pillar two say really? It says that the ultimate objective is that multinational enterprises must pay a minimum amount of tax globally. And how is that supposed to be ensured? Three ways. There are three rules that are being discussed. The income inclusion rule, which means that if there's an Indian company which is paying tax in India, and it has a subsidiary in Africa, uh, in some country in Africa which does not levy tax or levies a very low rate of tax, then India can say that since your tax is lower than the standard average rate of tax, the average, let us assume that is 12%. So if that country is levying only 5% tax and their standard is 12%, then India could say that, look, my subsidiary in your country is paying only 5%. I will charge the additional 7% tax on its income and appropriate it towards my treasury. So that's the income inclusion. You include part of the income of the subsidiary into the income of the parent in your jurisdiction. The second approach is the denial of deduction. We say that if you're making payments of dividends, of royalty, of interest, or not dividends really, but deductible items like interest and royalty or service charges to an entity somewhere, to a jurisdiction, and that income is not being taxed in that jurisdiction up to the desired standard rate, then my country, I could decide not to allow a deduction or to allow only a limited deduction for on account of that payment. Something like the limitation on the deductibility of interest that we have brought in already. One that's on an assumed basis. This could be on a basis that where we actually see that the payment of interest going from India to the foreign country is taxed only at 3% out there, whereas we should have taxed it at 12%. And so we said then we then do not allow deduction to the proportionate amount. And the third way is the subject to tax principle, where we don't allow treaty benefits. Again, for payments of dividends, interest, royalty, we don't allow the reduced rates of tax as per the treaty if that payment is not going to be subject to tax in that other jurisdiction. So these would be all be ways of discouraging jurisdictions from sticking to rates of tax which are low or are extremely lower than the standard or global averages. The ultimately what should happen then is that every country tries to bring up its tax rates to such a level where the average rate of tax of any multinational enterprise does come to that certain level. So that's the underlying principle behind Pillar Two. Uh, that every multinational enterprise, if you take its consolidated profits, global profits, then some minimum portion of that must be paid out as tax, and the allocation of that tax, of course, can be decided in a different manner. But then that's the amount of tax that the enterprise must pay. You can't be a Google which is paying just 3% tax on its global profits. So that's the whole logic of Pillar Two out there.
Yeah.
So three approaches are there. The discussions are going on which is the most preferred approach. There are different countries have different stands. Uh, for countries which are more concerned about outbound investment, by which I mean the more advanced economies normally, and then even countries like China or even India, I think in a few years we should reach that stage. Uh, then we countries like India could then prefer the income inclusion approach because we are concerned more about our own companies, our multinationals paying tax in India. So we do want, and I don't want to take names, but let's say I do want Bharti Airtel to pay the right amount of tax in India. So I don't want it to divert profits to a subsidiary in Africa, and that subsidiary not being taxed in that country. In that case, I would like to bring that uh, the differential amount of tax in India. So outbound investment, normally people would opt for an income inclusion approach, and that's why most of the advanced economies are doing that. Um, for the countries like India at present, we are more of a source jurisdiction at the moment and worried more about inbound investment. Here, I think it's the denial of deduction or the subject to tax approaches that will be more preferable. But these are all things which are under discussion. As I said, there are many issues here which are yet to be sorted out. The first basic issue being how do you compute the consolidated profits of a multinational enterprise, considering, and I think you know better than me, on the different accounting standards and different countries and the different information available.
I can only tell you, sir, that it's a nightmare because each country has a particular way of computing profits and accounting for particular things, and if you try and reconcile them, it's practically impossible, to be very honest. So there'll have to be one uniform accounting standard also that the world probably needs to approve.
Probably. Yeah.
But anyway, coming back to pillar one now, really we talked about the ABC approaches, and we also talked about what India kind of has done. Are you really happy with what has been done, or you think that something more should be done on the pillar one as far as India is also concerned?
Well, as mentioned, I'm personally not very happy with how discussions have progressed. We had started off the discussions by saying that there has to be an alternate nexus. And once you establish that nexus, then you find one way of allocating profits to that nexus. And the most efficient way, then, according to us, would be the way of fractional apportionment, where you take the revenue arising from each jurisdiction and you find a formulaic approach in which the total profit of the enterprise is allocated going by the revenue earned in each jurisdiction. So that is what we had hoped for when the discussion started. That's where we were aiming, and we are still aiming. What has come out really, what is happening now is that there is a curious mix in the proposals, a mix of traditional concepts and principles and some very advanced and out of the box thinking. So, to a large extent, the current scenarios continue. Wherever there is a marketing subsidiary or an arm or an entity in existence, normal transfer pricing principles will apply. Perhaps a standard return will be agreed upon, but then that there will be an allocation based on arm's length principles. Uh, it's only if there are profits in excess of these routine profits. So if an enterprise has, let's say, 100 billion as profits, and if 70 billion of that is allocated according to normal traditional transfer pricing principles, then only 30 billion is something which is in excess. That a portion of those profits out of that 30 billion, maybe 25 billion are ascribed to the parent jurisdiction because of the IPRs and the technology. The remaining 5 billion could then be allocated to market jurisdictions in the proportion of the sales revenue. That's the broadly the current proposal. So it's only in respect of a portion of the excess profits, and if there are excess profits. What we had envisaged was, or we believe is, that once you define a nexus, then one cannot split profits and say, okay, this much of the profit I will allocate according to the old nexus rule, and this much of the profit I will allocate according to the new nexus rule. Then there has to be one nexus rule. If so, what we would have wanted is that, or you have an alternate to the fixed place of business. There will be scenarios where the fixed place of business is not in existence. There, the nexus is comprises of the significant economic presence, and in that situation, the income which is to be allocated to that significant economic presence should be computed on a formulaic manner, uh, uh, not constrained by what has been happening on the fixed place of business. Of course, there are issues there because you can't have 5 countries going by the fixed place of business and 3 countries going by the SCP, and that's where the proposal really got stuck and is not being taken further. But then logically, we are not happy that we are splitting profits into routine and non-routine. We are using transfer pricing and at the same time saying that we want to depart from transfer pricing. We are sticking to the separate entity approach and yet at the same time saying that no, we are going beyond all that. So there is no clarity of approach that what we would like to have in the proposal as they are. But
And
this,
sir,
as I said, yeah.
sorry, sir, would you therefore believe that the deferral of SEP by 1 year in India is probably to kind of come to that sort of, or attempt to come to that sort of a conclusion? And would you believe that really from an SEP perspective, have we gone a little too far? Because we are also trying to tax sale of goods. Now, sale of goods is not something which is really in that sense digit in that sense. It's physical. And therefore, we have kind of put in a threshold even for sale of goods. Of course, that threshold will be notified. But the whole point is that have we gone too far in terms of, reaching out with the SEP?
Well, no, actually, the introduction of the SEP in our Income Tax Act was more of a policy statement rather than a taxing measure. We knew all the time that unless we have a corresponding provision in the tax treaties, this sort of an SEP provision will be of no use. Yes, of course, there are non-treaty jurisdictions, but then the amount of transactions that we have with those jurisdictions is not so much compared to what we have with the treaty partners. So it's, I think we always understood that this is more of a statement, a policy statement, rather than something which is meant to be implemented. Having said that, what we did say was that we wanted to keep the provision broad enough. So we wanted to include physical marketplaces dealing in physical goods also in that purview, and hence you have the goods, mention of goods out there. We there was a clause, there is a clause out there which say that the once you have an SEP in existence, then the income that can be taxed is only that which is attributable to that SEP, and that attribution rule is supposed to take care of removing all extraneous things and taxing only the real income which is arising from that significant economic presence. So that is how it was structured or designed in law. The deferment is just a technical matter actually, because we were supposed to prescribe rules, the thresholds, um, but then since the discussions were going on at the inclusive framework multilaterally, the government decided not to notify rules because that would be unnecessarily um, creating complications. So if you're not able to prescribe rules, then what is the point of keeping a provision on the statute? That's really the reason for deferring it by 1 year, because we hope that by that time, some consensus will be reached in the inclusive framework. So the act of deferring is something different. It's not really connected to what we thought of the SEP. And I don't think we were really going. There's not an overreach. It was just trying to make a statement of policy which is broad enough in scope, and to say that, look, we can do this and we would like to do this. And in any negotiation, as you would be aware, you always start with the moon and then you
Yeah.
try and bring them down to the smaller parts.
Absolutely. And so that brings us to one more interesting dimension, that if you see certain recent judicial decisions, somewhere the concept of a virtual PE or a digital PE somewhere has been kind of mooted now. And what would you think? How would this interplay with the SEP? What do you think? Will be the fate of something like this? Is it a very adventurous kind of a concept, or do you think that something like this can probably find place in statutes tomorrow?
Yes, there are a number of issues there which can be thought of. Uh, even in going by the traditional law of a fixed place of business. And in that context, I mean, we have already been experimenting with this virtual PE and the server-based PEs. Um, Perhaps this issue becomes more important now with the data protection policies of the government. You are aware of the data localization requirements that our data protection policy has included. So if enterprises are supposed to maintain data locally in India on servers, then there could be situations where that server could act as a P even under traditional principles. Um, Secondly, the jurisprudence or the judiciaries just does seem to be moving towards uh, a more substance over form interpretation of what is meant by a fixed place of business. So we had the Formula One ruling of the Supreme Court, where the sort of a permanence test was really modified. It was said that in 3 days the enterprise could carry out its whole business in India, and so it doesn't need more time. Other concepts like at disposal are also getting modified in different situations because of what's happening in the general economy. So there is a tendency now on the part of the judiciary and the judicial authorities to try and build upon these concepts and try and mold them into a way that they can fit into the current business models. So I think these issues of virtual P and server P will continue to be important. It's not that we are abandoning the traditional law. It's only that we are trying to supplement the traditional law with new concepts like the significant economic presence. But the traditional law continues, and uh, and therefore these concepts will remain very relevant. And it is really rather interesting to note the way in which judicial thinking is developing in these discussions.
Right, sir. Let's move to the draft report that the CBDT brought out on the attribution of profits to the PE, and it generated amongst us professionals at least a lot of discussion, lot of debate. So your thoughts on where this is going? Of course, it's still not kind of crystallized in terms of rules, but where do you see this going?
Well, I think that will, sooner or later, is bound to come into the domestic law. You are aware that the only rule that we have in the existing law is that Rule 10, which is an extremely broad and very amorphous rule. It doesn't say anything really. It says whatever the assessing officer deems fit. Essentially, it says that. So I think it's high time that we construct or formulate a more precise rule, a more objective rule which can be applied in different situations. And that was the main reason for that exercise in trying to formulate rules of attribution. Uh, and the factors for attributing profits, I think, have been correctly identified out there in that report. The weightages are something which can be decided. That's not so important. But I think those sort of attribution rules will, at some point of time, come into our rule book. The only reason they haven't done so far is that of the ongoing discussions in this inclusive framework, everything seems to be on hold till and to give them a chance to come to some sort of a solution.
Right, sir. And when we talked about weightages, we think that there will be some sort of safe harbors that can be brought in when we try and attribute the profits to a fee, such that, at least in the smaller situation, a taxpayer doesn't have to really worry. And, it is then, I know that, the approach that we are following is a formula based approach in a way. But even then, for a smaller taxpayer, probably it's just easier for him to, take a call in terms of, okay, this is going to be my profit.
I think that's very sensible. That's something which may be a reality in the near future. But as I said, now that we are moving towards a stage where we are thinking about consolidated profits of profit allocations across the globe, of enterprises as a whole, and not going by the separate entity approach, then these sort of safe harbors are something which might be one of the essential steps for moving ultimately towards that. So yes, I think one should examine this possibility of prescribing certain safe harbors which can, in different types of businesses, which can enhance the certainty.
Right. So let's move quickly. I know we're probably eating into the audience's time for questions, but very quickly moving to the MLI, you've really driven the BEPS project as far as India is concerned. And, are you really satisfied with where India has got to in terms of, BEPS and MLI, particularly, minimum standards, LOBs, etc.?
Well, yes, I think the BEPS project was quite a success, because consider the fact that no serious effort at tax reform had been undertaken globally in the multilateral forums till this BEPS project came up. And there is a lot of criticism to say that you had 15 action points, but what really has come out of it. But I think what has come out of it in the form of minimum standards is itself very substantial. You have anti-treaty abuse rules, which are a reality now, brought in through the MLI. You have transparency dictated by country reports, which is a huge step forward. I think there is much more now known about multinational enterprises than what was known earlier. You have the dispute resolution, emphasis on dispute resolution, and the action on the harmful tax practices. I think these minimum standards are by themselves are huge developments. So I am personally quite happy. One can't hope for a revolution in international tax every year. So these things take time. The BEPS things took about 3-4 years. Maybe these new developments will take another 2-3 years. But then that's how tax policy will move.
Yes, sir. Thank you. You touched upon, sir, the interplay between MLI and domestic car. I'm sure the viewers would like to hear your thoughts on how the two would interplay much more specifically. Would you think that now with the principal purpose test being there, GAR is somewhere kind of becoming redundant? Is principal purpose a more stringent test as compared to domestic GAR? How would the two apply, in conjunction with each other?
Well, I think I don't see any conflict between the two. CBDT has also clarified that both could exist. That if a principal purpose test is not adequate in addressing a situation, maybe the domestic GAR can be applied. But in practice, yes, several issues will come up when we start implementing them. You are aware of the differences between the two. The PPT, it just talks about one of the main purposes being one of the principal purposes being getting a tax benefit under the treaty, and the GAR being much more strict in the sense that wants it to be the main purpose is to get a tax benefit.
We dropped one of the main purposes when we were discussing that.
Yes. So we have now come to a stage where the domestic GAR is in fact difficult to apply because it is not very easy to establish that getting a tax benefit in an arrangement is the main purpose of that transaction. But I think what will happen is, as I see it, that if there is a question of a treaty benefit where both PPT and the domestic GAR could apply theoretically, then it would be the PPT which would first be applied because it is part of the treaty, and that's how traditionally these things are approached. And but then there could be many situations where the PPT is not enough to address the problem, because the PPT rule, as you say, it has a saving clause. It says that unless the granting of that benefit is in accordance with the object and purpose.
Yeah.
Now that's a very significant term out there. What is the object and purpose of the treaty is something that can be as open for discussion and interpretation in a particular case. So it might happen that a, a, a situation satisfies that object and purpose test, comes out of the PPT, yet it is hit by one of the principal provisions in GAR, for example, something which says that the relationship is not at arm's length. That's one of the clauses in the domestic GAR. If it is not at arm's length and if the main benefit is tax, then the domestic GAR could still apply. So I think both they are complementary. How they will play out remains to be seen, but I don't see a conflict there.
Yes, sir. So the last one that we come to for MLI at least is this whole interplay between MLI, data localization, etc. Do you think therefore that the multilateralism will be new and it will be the new normal? Do you expect that an inclusive framework will remain in operation longer than what it was thought about?
Yes, I really believe so. I think, as I said, we have in the world of tax, we have definitely moved towards a multilateral framework. We, no significant policy change internationally is now, I think, possible without a degree of consensus or agreement on that. And once that we have set in place institutions like this inclusive framework, well, everything sort of is coming within its fold. The MLI has demonstrated that consensus changes in treaties can be done in an coordinated manner. So I think that's the new norm. Yes, that's a new normal. Multilateralism certainly in this field of international tax, and I think the government must realize that in all matters of international tax, we have to we go along with and we have to be part of the international consensus.
Yes, sir. Sir, and I don't know, one only hopes and prays that COVID does not derail this process, but, we leave that to the forces to kind of decide. Uh, so just two or three small questions when, the last part of your, address. Really, and one thing that probably is, disturbing everybody or at least generating a lot of debate, I see, is that the amendment to Section 6 and, really the genesis of that or the root of that came from the recommendations of the task force. So, if you could throw light on, how it was envisaged and what it has become today, that would be very useful.
Well, that's an extremely interesting topic. I think there have been several webinars on this on this subject itself. Uh, um, let me see. Let me tell you how I look at it. Yes, it was a part of the task force recommendation, not in the form that it has come out in the final law, but certainly it's part of the recommendations. Now, let's look at it this way. The new business models, the new ways of doing business have changed a number of things. They have changed the meaning of many traditional concepts. We talked about things like the separate entity principle or the fixed place of business. These are all terms and principles which are under strain. Uh, Similarly, the concept of residence is also under strain. Residence was supposed to be the primary base factor, the tax base factor, which could evolve that nexus because people were generally expected to reside in a place to carry out any earning activity. If that assumption is no longer valid, then I think one has to be ready to move beyond the traditional thinking of residence and to then think of ways in which to stop or prevent the erosion of tax bases that could happen by manipulating residences. So that's exactly what has been the underlying principle behind the amendment. Yes, we did propose that Indian citizens who are still holding an Indian passport, let's say, who do get some benefits of being Indian citizens, if they are not tax residents of any country in the world, then there should be a residual right of taxation with the country of which he is a citizen, and that's something which I think we should be prepared to progress towards that thinking and expand the concept of residence because in many cases it is not functioning at all. The other part was, of course, where the of the NRIs who are coming in, that's clearly an anti-base erosion because we had noticed several cases where the 180 days time limit for the visiting NRIs was proving to be a bit too long, and I think it certainly needed to be reduced. Of course, now that we have also brought in the NOR status for them, it does take out most of the uh, strength or the bite from that amendment. We did not recommend any such thing in our task force report. But there can be many discussions on this and how it will play out. Part of the complexity that people are talking about has come about because of the way it was introduced and then sort of withdrawn partially by bringing it into the NOR basket. When we do that, then you create more and more complications as to which comes first. This happens or that happens. Which test do you apply first? All those things can happen. So there are complications, yes, that, and I think by and by they'll get reduced. But conceptually, I think it is a sound move. It is what is required to be done.
So one final question before I, let the floor open for the audience question. Uh, Given the fact that now we've moved so much towards combating tax evasion, do you think that because of the multiplicity of GAR, SAR, etc., PPT, all of that, the way we tax professional understood tax planning, that concept is now dead? And really, what would be your advice, the top two things that you would want to convey the tax to the tax professionals in this, highly uncertain post-COVID world?
Yes, yes. As I said, I mean, there are several of these things coming at the same time. You already have a PPT rule, you have a domestic guard. 1 or 2 years down the line, you might have this anti-evasion, anti-avoidance general rule of minimum taxation. So where does the tax planning then center on? And that's what I said. I think for the present, uh, it would just be good sense to pursue the road of substance over form. I mean, that's the basic principle out there. Let us not try anything adventurous. Let us not try and implement new ideas which are bordering on the substance over form dominance, but just go straight away and establish a whole lot of substance in whatever arrangement is being put in place. And I think that should be the fundamental or the basic uh, quest for each tax professional.
I always say, sir, that the devil lies in the fine print and in the documentation. So I think the importance really of documenting what you're doing cannot be overemphasized.
That's right.
Now,
That's right.
unfortunately, in some of the older structures, we've seen that, the documentation is just not there. And therefore, inferring purpose is also going to become, more and more difficult. But given that, yes, thank you very much. Very useful, very enlightening, very erudite in terms of discussion. Let me throw open the floor to the audience questions, and Hinesh or Rajesh or Amaya can take those questions.
Yeah, Ameya, can you please take up the questions?
Sure. So a lot of questions through this last 1.5 hour, and many of them have been addressed by Akhilesh ji. Akhilesh ji, there's a question from Rajat ji. There are two questions and a comment. So the first question is, do you think making amount, so this is on pillar 1 and 2, do you think making amount B and C and pillar 2 as a precondition for discussion on digital taxation justified? Why can't these unconnected complex issues be not tackled separately? It is somewhat like linking nuclear disarmament and climate change negotiations together on a lighter vein, he says. So that's the first question. And the second question is again on the unified approach. Don't you think that the unified approach has been devised in a manner so complicated so as to be extremely cumbersome in terms of implementation, even if consensus is reached? Unitary determination of consolidated profits for M&E group as a whole means any dispute in one jurisdiction will unsettle the whole thing. Dispute resolution will hence be taken to another level of complexity.
Oh yes, of course. For the first part of the question, let me just go back to the genesis of this pillar 1 and pillar 2. Um, in the post BEPS environment, when we had sort of reached a stalemate as to what is to be done with the digital economy, uh, proposals came from the US and from the UK. At that time itself, there was this proposal from some European countries, which tended to believe that the problem could actually be resolved by an anti-avoidance provision such as the one being talked about in Pillar 2. France and Germany were the leaders in moving that proposal. Uh, it was their understanding that the issues that are there in digital taxation can be resolved by just assuming an average rate of tax, and that itself will persuade multinationals to change their business models. And that's how, thereafter, when the discussions went on, both were being discussed simultaneously, the pillar 1 and the pillar 2, uh, in a way telling all countries concerned that, look, yes, your voice is also being heard. We are aware of what you are saying. We are trying to take everybody along, and I think it was more of a political necessity to consider both pillars at the same time, rather than any economic or technical necessity. Uh, on the second part of the question, yes, in the future is not very bright. I entirely agree with you that even if we are somehow able to reach consensus on the pillar 1 and pillar 2, even the pillar 1, for example, how do you compute that residual profit? There has to be, first of all, a computation of profit. There has to be then a computation of standard profit, and then a computation of residual profit. And uh, if we are, and who is that person or who is that authority who computes these profits? Who tells India that, okay, look, you can tax so much of profit, or is it the Indian government itself which decides that? So yes, in this age of multilateralism, which will have to come in, where profits are determined in a centralized fashion, where the allocation is decided in a multilateral way, then there will be new variety of disputes coming up, where obviously when one country is saying that no, this is not correct, this is not giving me the right share, and the other country is saying that this is probably a bit beyond the law. Uh, so it's going to be raise a fresh range of disputes which we haven't encountered as yet, because they may not really be on whether there's a PE or not, but the dispute would now be more on quantifying the amount of profit allocation, and that's going to be a very, very difficult exercise.
Right. The next question is from Radhakishan Rawal, is on the MLI and PPT. He raises a question that MLI PPT is broadly comparable to domestic GAR. Assessing officer on his own cannot invoke GAR, but has to follow an approving panel route. However, there is no such approval required for invoking PPT. Would the assessing officer be allowed to invoke PPT without approval of the senior authorities? And there is also another connected question is on the grandfathering with reference to the PPT. If you could take up both these questions,
Yeah,
sir.
yeah, yeah. Well, I think we have to look at the PPT rule in a different way from what we're doing and looking at GAR. The PPT rule is a part of the tax treaty. It is part of a bilateral treaty between two countries. Two countries have agreed. I mean, the provision may have come through the MLI or whatever, but essentially the two countries have agreed to incorporate a provision in their bilateral treaty. And when two countries have decided to have a provision in their treaty, then it is not required to have an approval of any third party to implement that. There is no prior approval in principle required, because these two countries have already agreed upon it. Now, there may be some gaps in understanding of what PPT means, how will it be applied. These are things which the two countries are supposed to talk amongst themselves. That's the bilateral treaty principle. So whatever disputes, whatever problems are there in implementing the PPT, these are to be resolved by the treaty partners themselves, and that's why there should not be, in my opinion, any any interference by any other panel. The domestic guard is a separate animal altogether. It's a creation of the domestic statute. It's something an opinion of the tax officer who thinks that there is a situation where the main purpose is of a tax benefit, and that must be put to test, because his perception must be tested. He is acting unilaterally on his own. He has the feeling that's not the same as a treaty situation. So I don't think we need the same sort of safeguards when applying a PBT. The safeguard is embedded in the treaty itself, in the process of consultation between the competent authorities. The second part you said again, grandfathering, same principle, absolutely the same principle. Treaty changes, when they are brought in or incorporated into a treaty, they have their own way of coming into effect. That coming into effect is also something which is decided by the treaty partners. So these are issues that where governments are not involved. One government can't say that no, this has to be in this way. You have to talk to the other government also. The two governments must therefore decide, and we can't have a judge of the Supreme Court sitting out here and say this is how these two treaty partners should interpret a particular provision. That's my view on it, Mr. Rakishan Rawal, and I don't really think that we should import this concepts from the GAR into the implementation of the treaty.
There's a question from Hitesh Gajaria. This is relating to the mandatory arbitration. You know, essentially, in the inclusive framework, agrees to mandatory arbitration, implementing whatever consensus emerges. Will it be a challenge in the absence of a mandatory arbitration? So he's raising a question around it.
Yes, this issue, of course, has been very, very seriously considered uh, um, in India. We have our objections to that mandatory arbitration are known. We are also aware at the same time that the nature of disputes in implementing these provisions is going to be such that normal map proceedings may not really suffice. So the stand that we have taken all along is that no, yes, we do need enhanced dispute resolution measures. We don't like third party arbitration. Let us think of alternate measures. Uh, there is new thinking going around in here in the courts in India. There is new thinking in internationally. We could think about processes of mediation. We could think about processes of a sort of consultation at the government level or mediation at the government level. I think these are things that can be thought of. We are supportive of those initiatives, but uh, but we do need enhanced measures, and that's the answer to that question. We believe that any solution which emerges from the pillar one and pillar two will incorporate a dispute resolution mechanism, and we are willing to participate in discussions on that to see that a more enhanced system is brought into place, which is not the same as third party arbitration.
Right. There are couple of questions, both interconnected. One is from Hyderabad, from Mr. PVSS Prasad. In the concept of significant economic presence, our government's approach would be to carve out principal to principal sales from the ambit of taxation in the market jurisdiction, such as such sales were never taxed in the market jurisdiction. Would that concept undergo a change in the digital age? And the related question is from Mr. Rajesh Gandhi. Is the equalization levy provision is worded very, very broadly and can cover host of transactions such as import of goods, where parties contract online management services provided over email. Do you think the government will be tempted to bring all such transactions under the levy, or restrict the levy to online e-commerce platform in true sense?
Well, on the first part of the question, I think one has to go back to that basic assumption underlying the significant economic presence. The assumption being that the that the level of activity or economic activity in a jurisdiction is so large that one has to consider a certain amount of business activity actually being performed, even though there is no physical presence in that jurisdiction. So when we are talking about principal to principal sales, in normal course, of course, these sales would not give rise to income. But then if these sales are part of a whole multitude of transactions which indicate the existence of a significant economic presence, then it is to be assumed that there is a certain amount of business activity underlying those principal to principal sales also, and therefore some part of those sales can be brought to tax. So I think it's just the way that one has to visualize. I mean, think of the SCP in abstraction rather than trying to merge it into the known concept of fixed place of business. And on the equalization levy, yes, as I had mentioned some time back, the scope as the law is drafted does appear to be rather wide. I think there is a need to clarify certain things to make that scope more clear and more cogent. In fact, um, I don't think that the intention of the government should be to tax each and everything, anything that has any digital connotation, because we are already living in a world where almost everything is digital. So we can't just go around taxing everything in sight. I think we'll have to have clear policies on what we want to tax, what is the income that we are not able to tax otherwise, and which we would like to tax, and considering the materiality of taxing that income, come out with a clear scheme of taxation.
Hinesh bhai, Anish, it's almost 6 p.m. Should we take a couple of more
Yeah,
questions?
maybe 2, 3 more, which are very important. You can just check up.
Sure,
Amir.
sure. Yeah, I've shortlisted. So
Yeah,
there's a
about 2,
question
3. Yeah.
is if pillar 1 and 2 are implemented, is it still
Sorry,
necessary
I mean, I
to have
lost you.
other measures like PPT? Yeah, sorry,
Okay.
sorry.
Ameya, can you repeat?
Yes. If pillar 1 and 2 are implemented, is it still necessary to have other anti-avoidance measures like PPT in the MLI? So that's the first question. And the other question is around equalization levy. Is the new levy in accordance with India's obligation under GATT and GATS, the WTO obligations?
Okay. On the first question, yes, of course, it is essential to have the PPT, even if you have the pillar 1 and pillar 2 consensus coming through. Let's come to that pillar 2 again. To reiterate, the pillar 2 only seeks to ensure that every multinational enterprise pays a minimum amount of average tax on its income. That's the basic objective. On the tax rate itself, on the proportion of tax out of the income. That's not a treaty matter at all. What the PPT is trying to address is a benefit being obtained under a tax treaty which the concern was otherwise not entitled to. And so I think the two operate in totally different spheres and totally different environments. And I don't see a conflict at all between the result of a pillar 2 and the PPT rule existing simultaneously. On the other, I think you, what was that question on the equalization levy is, what is it?
Whether it is in compliance with the
Oh.
WTO commitments.
Oh, okay. Well, I don't think that it is in contravention of the WTO agreement. And and I also don't think that a particular tax measure has to be in compliance with the WTO. I don't find any component of the general agreement on trade preferences which could indicate that unilateral taxing measures cannot be taken by a government. If the measures, taxation measures can fall under the purview of the WTO only if they prove to be discriminatory as far as trade is concerned. If they are hampering the free flow of goods and money between the trading partners. If it can be shown that the levy is somehow impeding commerce, if it is not allowing enterprises of one particular country or one particular area to operate, then there is a problem. But as such, theoretically, I don't see that it can run foul of the WTO understandings. Even when the US talked to France and asked them to hold on to their digital services tax, the reason for that, and which is officially given by the US, is that you are targeting US companies. It is because the French tax supposed to be or appeared to be targeting purely American companies that the matter was raised by the US. And that's something which the WTO could look into, because that would impede trade between the two countries. But if on a general level, if there is a levy, a unilateral levy, until it is shown to be discriminatory or counter to the flow of trade, I don't think it will run foul of GATT.
Right. We'll take
Sir,
the last
sir,
question.
there is one very interesting question from Mr. Asim Chawla. With OECD making itself of paramount relevance by Suomoto taking initiative of Pillar 1 and Pillar 2 exercise, is the intention of OECD to become clearinghouse of apportioning global tax? Very good question.
No, no. Well, yes. I mean, the OECD already is a depository of MLI instruments. It does coordinate how and countries are adopting new measures in their treaties. So it's already doing a lot of things as a central repository. It is quite possible that as I said, in the future, profits could also be dematerialized and kept in a depository by the OECD to be allocated according to rules. But I know it's something that we should not really dismiss. Although, yes, right now OECD is taking a principal role, because I don't think there's any other organization which is capable of taking that sort of a role to guide the discussion.
Thank you, sir. Actually, we have more than 90 questions, but we can't go further because already it's now more than 2 hours. I think I request Ameya to please offer you vote of thanks for an excellent seminar.
Great.
you.
Thank you, sir. Thank you. It has been a treat. It's like a Diwali in April in hot summer with fantastic comments from you. It's been a brilliant and intellectually stimulating exposition on the international tax law. A lot of takeaways for all of us as professionals. Thank you so much, sir, for sparing your time both for the preparation and for this live session. Taking all the questions and answering them candidly. Fireside chat are meant for that informal conversation. Really appreciate, sir, your time and valuable insight. On behalf of the Chamber and the International Tax Committee, we are very, very thankful to you for taking this session. Thank you to Anish as well for weaving brilliantly all the questions from the audience and his own questions as well. Hinesh bhai, as always, thank you for putting together a brilliant session yet again. And on behalf of the International Tax Committee, Rajesh and I thank all the viewers as well. We had almost over 600 viewers listening on a Saturday evening. And thank you to all of you for enthusiastically participating in this discussion. Thank you so much. And Rajesh bhai, over to you.
Yeah, thanks a lot, sir. And I think we close the session and we'll take the opportunity again and again from you, sir. And
Oh,
then
certainly,
we-
certainly, Mr. Welcome. Thank you so much.
Thank you very
Thank
much.
you, sir.
Thank you, Ranjan sir. Thank you very much. Yeah.
All right, Dinesh bhai,
Yeah.
thank you.
Rajesh bhai, I close the session.
Yeah,
Yeah.
sure.
Yes,
Yeah.
please.
Yeah.
Thank you.
Thank you.
Thank you.